Well, let me take a moment and just thank everyone for carving some time out of their day to spend it with us to hear from Deron McCoy, Chief Investment Officer at SIA. A lot of you folks have resources at SIA. We didn't make that as a requirement to participate in today's Zoom. SIA is one of our premier investment partners here at Legacy Consultants Group. But Deron's somebody who, over the years with my relationship with SIA, I've grown to truly appreciate, not just because of his advanced education, holding his CFA, CFP, CAIA, and AIF. But I think one of the things that truly attracts me to Deron and his entire team is the ability to take what are often complex concepts, ideas, and strategies and break them down in a way that all of us can understand. I think that education is only as valuable as a person's ability to understand it. And that ownership and that requirement really sets on the shoulders of the teacher to deliver that information in an easily digestible way. And so hopefully we don't leave any of you with investment indigestion at the end of today or economic indigestion. We think 2020 gave plenty of that to all of us as investors and economists and folks who have money in the market or are interested in the market. So Deron's going to share with us today really how the landscape's changed yet again. Certainly, we're glad that you're trimming the sails on behalf of our clients because the winds have been extraordinarily turbulent in recent years. So Deron, thank you so much in advance for what you're going to share with us. Some of you submitted questions in advance. I've got those in front of me. I've actually presented one of them to Deron already. If you have any questions that come to mind during this, I'll be reviewing the chat. The chat is open. Just drop them in the chat. And then when Deron's done sharing those, or when I see that it fits within what he's sharing, I'll ask those questions on behalf. So feel free to ask those as you will. Thank you, Deron.
Perfect. Thanks for the kind words. I have about 20, 30 slides for you, 24 slides. Let me try to share my screen. Hopefully this will work. And we'll hide the panel. Hold on real quick here. There.
You look great.
You look good? Okay, great. Thanks a lot. Thanks everyone for joining us today. The title, we could have a lot of different titles to this presentation. It's a change in the landscape, but what does that really mean to everyone? When you get a change in the landscape, from our seat, what we're talking about is there's new risks out there. The landscape kind of morphs and the business cycle kind of changes around. So when we're in a different part of the business cycle, we're looking at different risks, but we're also looking at different opportunities. And so we saw that a year ago when we moved from 2021 into 2022, that the landscape had kind of changed. And what I mean by that is we were coming out of the pandemic. We were just kind of chatting about it. A lot of money was thrown at the system to kind of get us through the pandemic. But then the result or the echo effects of that is that we had a lot of money in the system and too many, it's just supply and demand. When you have a lot of demand for goods and you have lower supply chains because of what was going on with COVID and around the world, you get higher prices. And so when you had higher prices moving into 2022, higher inflation, that just changed everything. And it really changed the landscape. And so that was last year. You had stock sell-off, you had bond sell-off, global assets just really had to recalibrate to a higher inflationary environment, a higher interest rate environment. So that was the bulk of 2022. So now we go into 2023 and we kind of see that being in the rearview mirror. So we're facing new risks ahead. So I kind of always like to put pictures to the concept. I think we kind of remember the pictures in the months and quarters ahead more than we'll remember an economic data point or some jargon. So I kind of came across this picture when we were putting together this presentation. And what you'll see here is we have a bridge and it's going across a river. And if you can see there's a small truck on there. I kind of think that's the investors, U.S. investors. We're making it across this bridge. Maybe we're halfway across the river. but you'll notice it's a pretty rickety bridge. It's not very safe. There's no guardrails. It doesn't look very new. It's kind of rusted out. So there's a lot of risks to this bridge. Now we're making it across the river, but there's risks behind us. I think that's 2022. That's the whole inflation and interest rate scare, and the ramifications from Washington, D.C., and the ramifications for our investment portfolio. But there's risks up ahead as well. And so that's kind of where we are. There's risks behind us. That's last year's landscape. And now there's risk in front of us, which is this year's landscape. So what was the risk last year? It was inflation. It was interest rates. We just talked about this. But we think that's going to be in the rearview mirror. We think we made it past that part of the bridge. And why is that? Well, we just got another inflation number yesterday. It was a little bit higher than expected. And they revised some of the past months to be a little bit higher than expected. So from, if you're just reading the headline in the Wall Street Journal, it looks like it's bad news on the inflation front. But it's actually not. So let me walk you through this chart. Just yesterday, we had an inflation print at 6.4%. Now that's elevated. That's certainly high. That's not in itself good news. But inflation is just a mathematical equation. It's the summing of all of the individual month-over-month inflation numbers. So a 6.4% number includes March of 2022, April of 2022. What happened in February of 22? Well, that was the Russian invasion of Ukraine. So you have a lot of shocks to the system already baked into this number. And, I think it's safe to say that Russia isn't going to invade Ukraine again. They're already there. So you're not going to get more and more shocks. And so the months that are coming, we will add to this inflation number, but more importantly, we're taking off last year's numbers that are elevated. So what that means is MOM is month over month. So December was a 0.1% month over month. October, I think, was 0.2. This last month was 0.5. So if we mathematically add these numbers to the annual figure, and at the same time take off February, March, and April of 2022, we automatically get down to a 4% type range, no matter what it is month over month this year. So inflation, what that means is that inflation will get into the 5s, into the 4s, and then into the 3s at some point in the first half of this year. Again, that's still elevated. The target is 2%. But what we have here is we're finally at a point where Jerome Powell and the Federal Reserve has short-term interest rates at a higher level than inflation, which means monetary policy is finally going to be in a restrictive area where interest rates are higher than inflation, meaning we can get a real return from a CD that we haven't been able to get from the last decade, really. So that's good. So inflation looks like it's going to be coming down on its own, just mathematically. But if you kind of go under the hood, kind of really dig into it, you'll see that the bulk of inflation here, this is a 1-month number. Some of it comes from, used cars, durable goods, energy. But the biggest number here is from owner's equivalent rents. So what the Federal Reserve does in the CPI numbers, it doesn't look at the price of your house. It looks at the cost to rent your house. And so what have home prices done since the pandemic? They've gone through the roof. When prices go up, rents usually go up because everyone wants to go to the suburbs and rent a home or whatever. So you have rents year over year extraordinarily high. And it makes up 40% of the index. So the bulk of this index, the bulk of inflation is just purely from rents. And if you strip out the rent number, inflation is running around 1.5. So we're kind of there. We're lights at the end of the tunnel. This inflation scare is over because rents are going to come down. this is getting into the weeds and I apologize, but how the Fed measures owners equivalent rents is there's a lagging indicator to it. It's kind of stale data. That's the government for you. I'm sorry. But if you look at more real-time data, and if you look at Zillow, you can see that rents have not only come off their high, but they're actually a little bit negative. So the rent number is going to come down if you believe real-time data from Zillow and others, which is going to drive 40% of the CPI number down. And again, just mathematically, we're taking numbers off from 2022. So inflation looks to be in the threes by the middle of this year. So that's great news. So we can kind of then say the inflation scare and interest rate scare is kind of behind us. But you'll notice we're not to the other side of this bridge yet. We still got a ways to go. And so what are the risks that lie ahead? Well, not to be a bearer of bad news, but we think a recession is a possibility, a real possibility, certainly an economic slowdown. And why is that? Well, you can kind of think about it. Inflation was at 40-year highs because the supply and demand just weren't matching up. The economy was too hot. So what did the Fed have to do? They had to raise interest rates to slow inflation. You slow inflation by slowing the economy. So this is just a normal business cycle. A recession and higher interest rates are correlated, but one just comes with a significant lag. So that's what's coming in the months and quarters ahead. We know we're going to get a slowdown. Whether it is an ultimate recession or not is still has to play out a little bit. We're still a little bit early here. So why do we think, logically it makes sense that a recession is coming, but there's data to support it as well. So how do we do this? We look at economic data all over the place. But one of the economic numbers that we don't look at is jobs. Everyone says, well, how can we have a recession? The job market's great. Well, jobs is not a leading indicator. It's not going to tell us what's going to happen. It's actually a lagging indicator. It tells us what already has happened. So let me give you an example. Let's say you're working at Starbucks. You're working 40 hours a week. If people stop coming in the door, they need less workers. But because of what's happened and trying to hire all these workers the last couple of years, they're probably not going to fire you right away. But so instead, what they're going to do is they're going to cut your hours from 40 to 38 to 36 to 34. So your hours get cut. And then if it gets real bad, then you're going to get laid off. So a leading indicator of what's going to happen would be average hourly weekly hours, your average weekly hours, but not at Starbucks. So we look at manufacturing that has a little bit better lead time for economic activity. So we look at weekly hours in the job market, and we also look at new orders. And we can kind of think of it this way. What did we all do the last couple of years during the pandemic? We all bought furniture. And so if you bought a new couch, you'll know that it wasn't delivered that day. It wasn't delivered the next day. It wasn't delivered that week. It was delivered, months later, if not a year later. So if you bought your couch in January, maybe it was delivered in June. When it was delivered in June, that's kind of when the money got changed hands, and that's when the real economic activity started to happen. Had to rent a truck, had to get the labor to deliver it, et cetera, et cetera, et cetera. So the new order in January gave you a hint of what economic activity would be in June. So the new order today told you what the economy was going to be in a couple of quarters. And so we can look at new orders in a couple of different areas. And then I put this under new orders. It's actually not a new order, but you can think of it as a building permit too. When you apply for a building permit, new construction, there's not a lot of money changing hands. There's nothing going on in the economy, but it gives you a glimpse of future construction in 6 to 9 months, when money is starting to change hands and when economic activity is really going. So a new permit today is a leading indicator of what will happen in the summer. So we look at all of these metrics and then we aggregate them all, and so we can measure and map it. And so that's what this blue line is up here. This is an aggregate number of all those leading indicators year over year, Y over Y. And so when it's going up, we have periods of economic growth in the 80s, here in the 90s, last decade. But then things go up, things go down, things grow, things contract. When it contracts, it breaks through zero. And now we're at this red line down here at around -5. What does that mean? Well, you'll see when it goes south and it moves below zero, it always predates a gray bar recession. Those vertical columns are recessions. And so when we get down to this sort of level, you can see every prior period is at that gray bar recession. So we can talk about the individual data points, but to keep it easy, 30,000 feet, the economy is telling us that there's going to be a slowdown later this year, which is not great for corporate earnings. If there's less economic activity, you're going to pull back a little bit and spend less money, and there's less activity going around. So corporations would earn less, plus their margins might be squeezed because of higher interest rate costs and higher other costs, and so their earnings might go south. So we looked at years where S&P 500, which is U.S. large cap stocks, saw earnings growth drop 10% or more. And these are all those years. But what's tricky in the stock market is that we're talking about an upcoming recession. We're talking about lower corporate earnings, but stocks predict the recession, not the other way around. So even when you have these years of negative earnings growth, you have the majority of time higher returns, which is really hard to grasp. And trying to explain this to my mom, I get lost sometimes. But again, how do stocks go up when earnings go down? Well, it's because the stocks have already predicted what's going to happen. So that might have been what we saw in 2022, because again, stocks predict the recession, not the other way around. So we think investors can make it across this bridge, this stock bridge, but there's going to be a lot of risks, because when you have those same years, you have a lot of volatility. You have a lot of chop up and down, up and down. So we think stocks can still make it across, but there's going to be a lot of risk. There's going to be some turmoil. There's going to be some chop. And we're already seeing it. This is not really new news. Markets went down, bottomed in October, rallied more this year. We're back to about May of last year's levels. So just a whole year of just chop. But we're also back to May of 2021 levels. So this aftermath of the pandemic and the echo effects just gets us a stock market that just is kind of getting whipped around a little bit. So what we want to do as asset allocators and looking around the globe is, are there other bridges that make it across the river, but have a whole lot more safety and security with it, right? This one is brand new. It's got guardrails. This bridge is fantastic. I'd much rather be on this bridge. So
I'm not taking my car across that first bridge, Darren. I'm just letting you know right now that I would not be on that bridge.
Exactly, right?
That's not my risk allocation. That is not.
Let's take the other one, especially if they're going to the same place. So let's look around. So kind of what else can get us that same kind of rate of return and with a lot less risk in global capital markets? We started looking at fixed income. And I was pulling up pictures of the bond market, and this one kind of popped into my head. This is the Department of Treasury that was organized, implemented in 1789. And if you know the Hamilton story, whether it's the musical or whether it's the $10 bill, you know that he started the secretary and started creating U.S. Treasury bonds and consolidating all the state's debt. Why am I bringing that up? Well, the interest rate move that we saw last year was the highest since 1788. So the move in interest rates in U.S. Treasuries last year actually predates the U.S. government issuing treasuries. It actually predates Alexander Hamilton. That's how historic last year was. So if you felt angst about the bond market sell-off. You're not alone. This is an historic event. So why do I bring this up? Well, when you get periods, dark blue, of higher interest rates, calendar years of higher interest rates, what happens in the next 12 months? You'll notice that the bulk of these years, when you have this higher dark blue line, you get a lower light blue line. You get lower interest rates the next 12 months. So when interest rates go up, usually interest rates come back down. The only time that you don't see interest rates come back down are these years. So let's look at those years. They're 1980, 78, 79, and 77. So it's the late 70s, early 80s time period. What was happening in the late 70s, early 80s time period? That was the era of higher and higher inflation. But if we think that risk is in the rearview mirror, then we can kind of throw out these comps or these examples that interest rates should move higher. So we don't think we're in the late 70s. We think that war will be won. We think it already is. And so we expect lower interest rates just because of the historic move that they saw the last 12 months. And if we do get a recession, interest rates almost always, if not every single time, move lower. So this is going back to 1987. Again, the same gray bar recession. You have interest rates peak and then roll over. Interest rates peak and then roll over. And that's the Federal Reserve trying to stimulate the economy in a recession.
Do you think that when we look long term, I think one of the things that I've got 4 young kids and 3 of them are sick right now. And last night my daughter didn't want to take her medicine, right? And I think sometimes as investors, we can all feel like that 4-year-old that doesn't want to take their medicine, right? When we look back, just maybe a few short years down the road on the moves, do you think we'll look at the movement by the Federal Reserve to move interest rates up this high was the medicine we needed to fight the next recession? Do you think that the Fed's now better poised to deal with economic disruption than what we were from, say, 2010 to 2016 when interest rates were zero? Do you think ultimately this is a positive thing for long-term economic prosperity?
Great question. And in a weird way, yes, because what we don't want is the 70s. We don't want a 4-year, 5-year period of higher and higher inflation that just sucks all the energy out of the room. And so by raising rates at a historic clip, you see that actually this chart here is the Federal Reserve and Jerome Powell raising rates. It's pretty steep compared to last cycles, right? So he had to, he took 2021 off, so he had to play catch up. And then he had to do it in a big way because inflation was at 40-year highs. So in a weird way, having a small recession this year and then getting back to normal in 2024 is a much preferred outcome than having a 5-6 year period of higher and higher inflation. And to your point, we're finally back into a normal environment where we can earn money in a money market and earn money on a treasury bond and actually recommend treasuries. We haven't done this in a decade. So now investors can lock in a 4 or 5% type of yield in a bond, which is somewhat attractive. And if interest rates go south, bond prices head higher. So if we do get this recession, you'll not only lock in the 5% income, but you'll get price appreciation as well. So now we're 6, 7, 8%, and that's just a treasury. If we look at the corporate bond market, we can get higher still. And if your portfolio doesn't need to be liquid in the next 3 days, we can look at some private alternatives and some other types of lending where you can get even higher rates of return still. So we're now generating rates of return that are on par with typical stock returns with a whole lot less risk. But investors are a little bit gun shy because of what happened last year in the bond market. And so I like this chart a lot. It's painful to go through a bear market, but investors need to realize that now we get to earn some yield off of our fixed income. And that increase in yield is actually better than where we would have been a year ago with no bear market, but earning 1%. So if you do the math, I think this is from Vanguard, the turquoise line is the growth of your wealth if rates didn't go up and there was no bear market. But if you have a bear market, but now you can reinvest this capital at higher rates of return, mathematically, you're going to be wealthier in 5-6 years time. It's just math. And if you can then do some of those other moves and reallocations I was just speaking about, the break even is even shorter still. So mathematically, bond investors should actually be happier going through this bear market than otherwise. So it's kind of weird, but we need to embrace this bear market in bonds and actually look to them as our friends, because we can actually earn stock-like returns with a lot less risk. And again, we haven't really said that in a decade. It's been such a long time. We kind of get numb to the, it's kind of like a frog in the pot type of example, but we get numb to low interest rates. But now we're back into an example where we don't have to allocate to stocks. We can get rates of returns elsewhere in the portfolio. So that's one bridge we can take. What else? Is there anything else out there? Well, let's go back to stocks. Some of these ideas we highlighted last year and last quarter, and they're starting to come to fruition. One is international stocks. And so we have a bunch of jargon on this page, so let me walk you through it. The ACWI index, that's the all country world index. So that's just international stocks minus the US, just overseas. The next 12 months, price to earnings multiple. So what we're doing is we're looking at valuations of what foreign stocks, international stocks are going to do in the next 12 months. And then we compare them to the S&P 500 US stocks. So all this is international valuations versus US valuations. When we're up here, international stocks are expensive. So think of right before the crisis. We had the huge build out of what? We had the huge build out of China. They were building an airport every day. It was the big run up to the 08 Olympics. So international stocks were really expensive. Fast forward to today, the last year or so, we are at historic extremes for US stocks. And as this chart shows, historic lows for international valuations relative to the US. So if we're worried about a recession and we're worried about the stocks selling off, it's probably a better or wiser or more prudent idea to allocate towards cheaper stocks, because the sell-off might not be as bad. And so, yeah, international stocks are cheaper. Let's give a real life example. So Exxon and Chevron, they're cheap stocks in the US, right? They trade at a 10 to 11 PE. They have margins, they have dividend yields. If we compare that to international stocks, Shell and BP, British Petroleum, you can see that they're even cheaper still. They're half as cheap. So we're getting the same sort of margins, actually higher dividend yields, but we're getting it at half the valuation or thereabouts. So that's kind of a real life example of why overseas stocks can start to become attractive compared to US stocks. Why are these so cheap? Well, it's because we have the same index, but this is not valuations, it's just returns. US stocks has been the place to be for the last decade. It's been a TINA decade. There is no alternative. We couldn't get yield in the US, and actually overseas, we were getting paid negative yields. Yields were negative in Japan, negative in Switzerland, negative in Germany. They were negative around the world except for the US. So money flocked into our dynamic economy. We had new social media companies and new tech companies kind of taking over. We had a great private equity market and some great IPOs. And so everyone was flocking to the US. Performance has been great, but what happens with performance is it makes valuations too high. So that's where we are today. That's just starting to turn. And international stocks actually outperformed in Q4 materially so. And then that performance actually led them to lead US stocks the whole of last year. So again, we're already kind of seeing this rotation into foreign stocks and away from the US market. Why is that? Well, the economic data is actually a little bit better over there. This is data surprises of Europe and the US. Europe is in turquoise, US is in red. You can see that the economic data is actually starting to turn up in the last quarter of last year versus the US is kind of getting weaker, like we saw with that leading economic index. And anecdotally, how could that be? Well, just recently, we had China end its zero COVID policy. So one of the largest consumer bases in the world has been locked down for 2 or 3 years, is now out and ready to spend money. And they'll probably spend a lot of money on European luxury goods. So think of Louis Vuitton type names. So the economic data for European luxury goods kind of looks pretty good right here. Interest rates are not negative anymore; they're positive. And so now Japanese banks and European banks can start to make money in a more normal environment. So that's a propellant for the economies over there. And maybe we get some peace out of Ukraine. If that happens, we'll get a little post-war little boomlet in Europe with lower energy prices and everything else going on. So the setup is pretty attractive for international stocks. And we have to remind ourselves that when we buy an asset overseas, we're buying an asset denominated in those overseas currencies. So we need to pay attention to the currency market. It's kind of foreign for people in the US, but overseas are paying attention to the currency market all the time. It's just part of their DNA. So what we have here is an index of the US dollar and its movements. And if you remember the 80s, it was a strong dollar environment, and then it turned around. And then late 90s, booming US economy, strong dollar environment. So the 80s, strong economy, 90s, strong economy. And then here we have, that build up to the Olympics and the Chinese build out and the overseas stocks doing really well, weak dollar, and then strong economy this last decade, strong dollar. So we're at a point now where the dollar is kind of toppy. It's pretty strong. Europe, I haven't seen it lately, but it's around 108, the euro. The British pound is around 120. Those used to be 40, 50% higher. And so if you're going to travel, maybe travel to Europe this year because the currency is kind of in our favor. But you'll notice here that currency movements take 5 years, 10 years. They're long. The movements are long, kind of longer term. They're not whipping around every day. And so if this starts to roll over, and it already has in Q4, we could see years of dollar weakness, which means years of foreign currencies appreciating, which means years of assets denominated in those foreign currencies appreciating as well. So what do we have in international stocks? We have higher dividend yields, lower valuations, all denominated in a currency that's appreciating. So kind of a trifecta of tailwinds for overseas stocks, which then kind of says, all right, that makes a lot of sense. We think that bridge gets us to the same spot, but there's a lot less risk in overseas stocks. Now, what I don't want to leave you with, as I kind of wrap up here, is that we need to shun US stocks and avoid them completely. The US economy is dynamic. It will move, bob and weave and kind of adapt to this new environment. We're seeing it with ChatGPT and all these new innovations. So we don't want to shun US stocks. But we see investors, because of the last decade, are materially overweight US large caps and US tech in particular, and materially underweight bonds and international and European names. So we just want to start getting back to kind of a more normal, neutral type portfolio. And don't forget that those other assets exist. We're moving from TINA, there is no alternative, into maybe more TARA. There are reasonable alternatives. So diversification is kind of back, and we want to be able to have assets in these other areas of the global capital markets, which again can get us across this river.
Do you think that any of the recent challenges with China, if you will, the escalating political turmoil between two countries, has any implications on either domestic, post-recession recovery? Do you think we're going to see any supply chain issues that come from that political turmoil, or have any effect on your optimism in general for international markets at all? Like, where does that? I know that's really crystal ballish. I know it wasn't but a handful of years ago that Kim Jong-un was shooting missiles off the coast of North Korea, and we're wondering, like, what does this mean to us? Like, international turmoil is unfortunately part of our landscape as a global economy, but this one seems to be a little bit closer to home to all of us that maybe aren't old enough to remember the Cuban Missile Crisis. This one feels a little more intense, if you will, when it's over our country, if you will. So, any thoughts around that and its effect?
Cuban Missile Crisis, and this one is a balloon crisis. It's kind of weird how that plays out. 6 months ago, we were, there was chatter on whether China was even investable. Should we even have any sort of allocation there? That kind of rhetoric has even besides the balloons, has come off the boil a little bit. He had a very tight zero COVID policy. And then the Chinese populace kind of rose up and said, we can't do this anymore. We need to change. And so that was kind of good news for the global economy. And then he actually started to relax some issues that were surrounding actual Chinese listed stocks, which is good for kind of the global capital markets, the actual tickers. So the policies of last year kind of ebbed here a little bit. There's always the risk, and everyone always throws out Taiwan and whatnot. But I want you to note that the bulk of these tailwinds, we're talking about Europe here. We're talking about Japan here. We're not really talking about a full overweight to emerging markets. We're just kind of not there yet for the risks that are evident. And so when you look at a portfolio, maybe we have 1% or 2% into those kinds of names. It's just not a real big material risk in the portfolios for this year. I don't really see it as an overweight. We really want to back up the truck and push money into a communist country, but I don't really think we need to be that fearful and be a material underweight or a zero allocation either. Yet that can always change, as we saw what happened in Eastern Europe. That can certainly affect global capital markets, and we would certainly adjust if it does start to spike.
I don't think it's uncommon for us. China gets a lot of headlines, but from an allocation perspective, I think that's always helpful to remember that the headlines are scarier than the portfolio implications that it has on our pocketbook, if you will.
Right.
Appreciate that.
Right. So, I mean, we can chat. Maybe you can open up the chat box, but that's kind of how we see the world right now. So let me kind of wrap this up. What made you fearful last year? We kind of got through that part of it, and by being able to rebalance and buy high and sell low in this choppy environment, we can kind of eke out some returns from the last couple of years. But now, what do we do going forward? Well, we think that sort of risk is in the rearview mirror. So then we kind of want to embrace those types of assets that have been hurt by that risk, because that risk isn't going to come back. So if interest rates are now nearing their peak, we want to do the opposite of a mortgage. In a mortgage, you want to lock in when interest rates are low. But by buying bonds, we're actually lending money. So we want to lock in interest rate. We want to lock in when interest rates are high. So that's kind of where we are right now. And then if interest rates do fall in a recession, we're going to get, again, a kind of a double tailwind of higher yields and higher prices for the next, call it 6 quarters or so. And then make sure to diversify the US stocks, because of the recessions, into some overseas names that are just historically cheap to where we are here in the US.
I know it was, oh gosh, a few months from now we'll hit the anniversary of Jamie Dimon saying that, referencing a hurricane, right? And you even
Yep.
had that in one of your presentations to the to the group that joins these, referencing the hurricane or two hurricanes, right? As we look at the data, it seems that that hurricane may have, you know, uh, not picked up the level of steam that was expected as it came to shore, right? What do you when the data we see, hey, recession, but at one point it was very alarming, very concerning. The words that were, you know, financial leaders were utilizing in description of what expected. Are you seeing data that suggests that yes, we'll have a recession, but it appears more of a grab your galoshes and it'll be safe to go outside versus, grab the plywood and batten down the hatches? What's the
Right.
what's the data say to you?
Well, it's a great. There's a couple of questions in there. That's actually why we pivoted away from the two hurricane picture into kind of this train bridge type of pictures, because if you have dual hurricanes, it's kind of hard to escape it, right? And you have to batten down the hatches and whatnot. Whereas this, I think there is a way to escape it. I think there's other avenues that we can go down and other investments that we can make to get rid of the hurricane of inflation last year and the hurricane this year of a recession. The one thing we need to keep in mind is when investors think of recession, they automatically go to a pandemic, or they go to 2008, or they go to the dot-com bubble, which is normal because those are the last three recessions. But those recessions weren't normal. One recession was a global pandemic, a once in 100-year event. One was a bubble in housing, and the other was a bubble in dot-com stocks. So we kind of had a mini bubble last year with Dogecoin and AMC and those kinds of names, but it's apples and oranges compared to their earlier bubbles. It wasn't the whole economy. So even if we do have recession, I don't think it's going to be cataclysmic like we've seen the last three times. I think it can be more of a garden variety. Think if you're investing in the early 90s, like a 93, 94 type of environment where it's just kind of blah for a couple of quarters here. And part of the reason is because probably everyone on this Zoom call refinanced their home over the last couple of years. And so corporations did the same thing. And so the US consumer isn't too stressed, and corporations aren't too stressed at all because they've already done their refinancing. So we're just not at the same level of leverage that we usually are going into a recession that really causes the severe sell-off in stocks. We're just not there this time. So the economy, and I've used this term in the past as well. The pain on Main Street might be coming with higher unemployment, lower home prices, but the pain on Wall Street might be behind us. And those two things, pain on Wall Street and pain on Main Street, aren't necessarily, they're correlated, but again, one comes with a severe lag. So let me give you an example on that. 2008, 2009, stocks were heading south every day. We're out in Los Angeles, so the stock market closes at 1 o'clock. And so then after that, we would head to the mall, go grab some lunch. Well, in 2008, 2009, we were tearing our hair out, but the mall was jumping. People were shopping, restaurants were full, activity was fantastic. But fast forward to 2011 and 2012, stocks were up 100, 200%, but the malls were empty. No one was shopping, no one was eating. Housing prices were still down. So stocks kind of predicted what was going to happen, and the pain on Wall Street kind of predicted the pain on Main Street. They were correlated, but they don't necessarily happen at the same time. So that's probably the setup that we're seeing in 2023 as well. You'll see, this bridge is rickety. You're not going to go on it, but we do make it to the other side.
Yeah, I think I was looking at some interesting data around recessions, duration, severity, and we just went back to back major in terms of decrease in GDP and duration. in 2008. And, the question I think we probably have to ask ourselves is, is really the economy grown enough to set up another major recession? Is there, are we really in that kind of environment? And, banks are certainly more stable today than they've been in decades. And I think I think that stuff really flies underneath the radar for a lot of people, is how are financial markets changed? How are capital markets changed, specifically in lending? And, one of the things we've been talking to people about is, we have very high credit time of application for mortgages. It's very hard to find data that suggests that the housing market bubble, and banks are better financed, less leveraged today, materially so, than they were in 08 and 09. And so you don't have this, spark that ignites the nuclear bomb. I know that's not how those go off. But you don't have that kind of systemic risk like we did in 08 and 09 today. And that you can't have a mild recession without everyone losing their shirt.
Right. And it's really the leverage that really causes all of the problems. And so when you have that leverage, you become a forced seller at the bottom. And that's really what we urge, if we're wrong and 2023 is something more sinister than we think, we just don't want to be a forced seller at the bottom. That's what causes the real wealth destruction. What we want to be able to do is have these other assets in the portfolio that we can embrace the bottom and really move in and really overweight US stocks and really generational type buying opportunities. And that's where the real wealth is created. So by having the portfolio construction and kind of the wherewithal to not be on leverage and not be a forced seller at the bottom and not having, next month's rent in whatever stock, really sets you up for success, and no matter what should happen.
I couldn't agree more. I think there's always opportunities. I think there's always, that's the you're talking about. We're talking about the endurance stuff that I do. And I think so often we get fearful. Fear is a very dangerous thing to utilize when it comes to investing in general, right? It's versus seeing the opportunity that lays ahead of us and knowing that, with an asset manager like you all that has the ability to dynamically change the way assets are allocated, not taking 100% of somebody's portfolio. So, just as a disclaimer here, Darren's not taking everybody's assets and putting them in 100% Eurozone tomorrow. That's not the goal here. And that's not how you get outperformance. This is investing, not gambling. So that's not his shtick nor our shtick. But I think the understanding of being able to keep cooler heads and see where opportunities exist and understanding the relationships of asset classes and valuations and where those opportunities are is what, gives us the ability to dynamically outperform those who get fearful and pull their money out, or head for the hills, if you will. So right. I appreciate that descriptor.
It's not anyone's fault. Humans just aren't wired that way. We're supposed to run away from a bear. That's how we survived. But we're not supposed to run away from a bear market. Should one persist, we embrace sales at Nordstrom or whatever. We need to embrace those sales in the stock market as well.
So what has history told us about higher interest rates? And is there any correlation? Like we've had these periods where interest rates, we had the increase in interest rates in the early parts of the 1980s, which set up a very, very meaningful long bull market and economic prosperity for those who can recall that period of time. Like, do we see a scenario where, and there's a lot of conversation about this with interest rates as low as they were for as long as they were, is that, this is having a muting effect on economic growth and financial prosperity. You kind of led to it a little bit in one of the earlier slides, but do you think this positions us potentially for more robust growth as the Fed, now has some interest rate room and to move rates lower over a longer period of time, and as a result, create the necessary stimulus for a longer period of economic growth in 24 and beyond? Like, are we in that kind of a scenario potentially?
If you think of longer term trends and you think about where we came from, you had a decade of just low interest rates, which propelled stocks that weren't necessarily making a lot of money yet. Think growth stocks, but potentially they will. So Airbnb just posted their first profit ever today. So that era gave birth to a bunch of growth names that were losing money hand over fist, quarter after quarter after quarter after quarter after quarter. Think WeWork or something like that. That dynamic, that landscape has changed, and it's changed for a while in this higher interest rate environment. The hurdle is higher. If you can make 7-8% in your fixed income, maybe you're not going to allocate as much to money losing growth stocks. And what will you allocate to? Well, you need, in a higher interest rate environment, you need corporations to be able to self-fulfill their needs. So you need a lot of cash flow. And that cash flow, is generally value stocks. Not always, but generally value. So we're kind of morphing back into a landscape that was maybe post.com bubble, where value stocks did really well in this new environment. So we didn't talk about that today, but we're kind of set up for a value trade to outperform a growth trade over the next couple of years as well. It's not as sexy or fun or exciting to talk about. No one at their cocktail party is going to talk about MetLife Insurance, the stock. but that's the insurance industry benefits from higher interest rates. They collect all of these premiums. They have to put it somewhere. If they can invest in a marketplace that generates yield, well, their earnings are going to be higher. So for every headwind, there's a tailwind. And that's an example of where different types of stocks perform better in a different type of environment.
It's awesome. I'm not seeing any questions come in, Deron, here today. And I could do this. You don't have enough time for me to ask all of mine, because I could have this kind of conversation until your wife's wondering where you are. So, is there any questions for anyone before I wrap up with Deron and yield back a few minutes of his time? Well, Deron, let me just personally thank you. I individually always appreciate your time, appreciate these dialogues and these conversations. I think one of the things I always like the way you think, and I like the way SIA thinks, and it aligns with me a lot, is I think how we see things, how we see the economy, how we see our life, how we see the world, dictates whether opportunities are available to us or not. And I think the philosophy that for every headwind, there's a tailwind is more of a perspective choice, right? And how you see what's available. I know your team, the Dimes team, does a lot of research to find those opportunities on behalf of our clients. So let me personally thank you for that. And on behalf of everyone here that has resources with SIA. I know we'll do this hopefully again later this year, but thank everyone. And I want to just take a moment as well to all here on the call or who listen to this. In years like 2020 and years like 2022, I don't know about you, I get tired of the word unprecedented. If I hear that one more time, if we could just scrub that from the English language for the rest of my life, it would be absolutely delightful. But it seems as though that is what we've had. And I think in those times, it's for me as a leader in everyone's life that's on this call and those who will listen to it later. So those times as a leader, I'm even more humbled in the trust that you place on me. It's easy to be trustworthy when the sky's blue, the sun's shining, everything's easy. But when things get difficult, that's the time where leadership matters. Leadership at Deron's team matters. And I truly just want to say thank you for that trust. It means the world to me. And we certainly are thankful. So if there's no other questions for anyone, got one that came in as I was chatting here. Cindy, I'll answer that one offline for you. I'll give you a ring. So very good. For those, just as a reminder, was Deron asked these, what Deron's talking about. SIA is a active manager, so they are making those changes. They have limited discretionary control over our clients' portfolios, which means there's these they're on the bridge, the bond and international bridge, right? So each of you have resources with SIA. We signed something called an investment policy statement. I'll kind of answer that a little bit, Cindy. So those guardrails we put up around SIA. So the value there is that not only do you get to have someone like Deron and his team that are looking at the international, domestic markets and making choices, they have the liberty to make those trades on your behalf. But we put guardrails that are appropriate for each one of your goals, objectives. I'll sound like a commercial, risk tolerance, and so that they're confined into how far they can go. so we can have the peace of mind that those things are being executed on appropriately, right? But they are not able to act with full liberty and do something that takes you outside of the appropriate risk for each of your families. So, very good. Deron, thank you so much for your time. Thank you everyone for your time. Deron, enjoy sunny California, my friend.
Sounds good. Thanks a lot.
You're welcome.
Thanks, everyone.